You are holding a carton of oat milk right now, or you had one in your coffee this morning, or there's one sitting in your fridge behind the leftovers you forgot about, and somewhere in the back of your mind, you've thought about it. Not just the milk, the companies behind it, the stock, the brand. The idea that oat milk is the future and maybe you should put money into it. Don't, at least not yet. Because the companies selling you that carton have financial filings that tell a very different story than the one their marketing departments want you to believe. And I went through those filings, so you don't have to. Let's start with the biggest name in the room. Oatly went public in May 2021 at a valuation of $10 billion. On its first trading day, the stock closed at $22 per share. Within weeks, the market cap pushed past $15 billion. Oprah was an investor. Jay-Z's Rock Nation was an investor. Blackstone put in $200 million. The narrative was irresistible. A Swedish company founded in 1994 by a food scientist who figured out how to turn oats into creamy milk, now riding the biggest wave in food history, the shift from animal dairy to plant-based everything. Fast forward to today, and Oatly's stock has crashed 98% from its peak. Shares that traded above $20 are now hovering around $1. The market cap has collapsed from $15 billion to roughly $345 million. And it wasn't one bad quarter that did this. It was 4 straight years of self-inflicted damage, all documented in their own SEC filings. In 2021, Oatly spent $274 million on capital expenditures, building factories across 3 continents. The next year, another $202 million. They were building production capacity as fast as they could pour concrete. But their execution was a disaster. The Wall Street Journal documented how their factory build-outs ran behind schedule, missed production targets, and delivered inconsistent supply to key customers. Starbucks, one of their biggest accounts, had to bring in a rival supplier, Sanopta, just to make sure stores actually had oat milk on hand. That opened the door for competitors like Planet Oat and Chobani to steal shelf space. Meanwhile, the losses kept piling up. $212 million in losses in 2022, $416 million in 2023, another $200 million in 2024. The company's own filings repeatedly used the phrase history of losses and inability to achieve or sustain profitability. That's not my language. That's the company's own risk disclosure, filed with the Securities and Exchange Commission. In early 2023, with cash running low, Oatly raised $425 million in convertible debt on what analysts called fairly onerous terms. They were borrowing money at painful interest rates just to stay alive, and their gross margin, the most basic measure of whether your product makes money before you even pay rent or salaries, sank to 19% in mid-2023. This is a company that sells water mixed with oats and vegetable oil for $5 a half gallon at Target. The margins should be enormous. They weren't, because Oatly built too much, too fast, in too many places, and couldn't run any of it efficiently. Their own filings now project profitability in 2025 for the first time ever as a public company. But even if they hit that target, it would be a single-digit million-dollar EBITDA on over $800 million in revenue. Investors who bought at the IPO have lost almost everything. Number 2, Beyond Meat. Now Beyond Meat isn't an oat milk company. They make plant-based meat. But they belong on this list because they are the clearest case study of what happens when an entire plant-based food category gets overhyped, and the financials never catch up. And the same investors who got burned on Beyond Meat are the ones now looking at oat milk companies. In July 2019, Beyond Meat hit a peak valuation of $13.4 billion. Shares traded at $234. The company was the hottest IPO of the year. Fast forward to late 2025. Shares dropped below $1. The stock crashed 99%. Revenue fell from $465 million in 2021 to $326 million in 2024, and then to $275 million in 2025. The company's operating loss in 2025 was $332 million, more than double the prior year. They recorded a $77 million impairment charge on their own factories, essentially admitting their physical assets weren't worth what the books said they were. They disclosed 2 material weaknesses in internal controls, meaning their own accounting systems had significant flaws. They exited China entirely. They had $1.2 billion in debt. Their days beyond terms, how late they pay their own bills, more than doubled, reaching almost twice the industry average. Credit-safe data showed that nearly half their outstanding invoices were past due. The company denied bankruptcy rumors but completed a debt-for-equity swap that issued over 300 million new shares to bondholders, diluting existing shareholders by more than 4-1. The stock dropped 56% in a single day when the deal was announced. And while all of this was happening, the CEO received $29 million in total compensation for 2025. These numbers aren't cherry-picked from hostile analysts. They come from Beyond Meat's own 10K filings, their own 8K disclosures, their own earnings calls. The filings told you everything. The market just didn't want to listen. Number 3, Califia Farms. This is the one people forget about because it's private, which means there's less public scrutiny and less accountability. Califia raised $340 million across 4 funding rounds. Their Series D alone in January 2020 was $225 million, led by the Qatar Investment Authority, with Temasek and Claridge also participating. At the time, the CEO called it one of the largest private capital raises in the natural food sector. They were going to disrupt the $1 trillion dairy industry. That was the pitch. Now here's the problem. Califia raised that massive round right before the world changed. The pandemic hit, supply chains broke, inflation spiked, price-sensitive consumers started trading down, and the plant-based milk category, which was supposed to grow forever, hit a wall. U.S. retail gallon sales of plant-based milk fell 7% in 2023. Oat milk specifically managed a modest 1% growth, nowhere near the explosive trajectory investors had priced in. Califia hasn't raised a new funding round since January 2020. That's over 6 years of radio silence on capital. For a private company that was supposed to be on the path to an IPO, that silence is deafening. The company had around 300 employees as of 2022, down from its peak. Their last notable acquisition was buying a small plant-based milk dispenser company called Uproot in mid-2024, a modest deal that doesn't suggest IPO-level momentum. Qatar Investment Authority, their lead investor, is a sovereign wealth fund that can absorb the loss. Most retail investors cannot. The fundamentals of the plant-based milk market shifted beneath Califia's feet, and without public filings, there's no transparency about how deep the damage goes. That's not a reason to invest. That's a reason to stay away. Number 4, Minor Figures. This is the London-based oat milk brand that built its entire identity around coffee shop culture. Cool branding, beautiful packaging, partnerships with independent roasters worldwide. The specialty coffee crowd loved it. Their financial filings at Companies House tell a different story. For the year ending June 2023, Minor Figures reported losses of £9.9 million, a 39% increase from the previous year. Revenues grew 9% to £31.8 million, but the losses grew far faster than the top line. Cumulative losses over 3 years exceeded £20 million. The problem was the same one that hit Oatly and everyone else, China. Minor Figures made a big bet on the Asia-Pacific market. When post-COVID demand in China didn't recover as expected, and the market filled with domestic competitors undercutting on price, Minor Figures had to discontinue product lines, write off inventory, and take £1.5 million in one-off restructuring costs. They pulled back from Asia and refocused on the UK and North America. By the year ending June 2025, revenue was £35.8 million, and management claims the company recently reached profitability. But cumulative total losses have now hit nearly £30 million. That's £30 million that investors put in that has been spent. The CEO says the business is now lean and focused. Maybe it is, but those filings are public record, and they show a company that burned through nearly £30 million before figuring out its geography, its product lineup, and its cost structure. That's an expensive education. And investors paid for it. Number 5, Oatside. This is the Singapore-based brand that's positioned as Asia's oat milk champion. Founded in 2020 by a former Kraft Heinz CFO, Oatside has raised over $118 million in funding backed by Temasek, Granite Asia, and others. They operate a factory in Bandung, Indonesia, and their products are available in 18 countries across Asia Pacific. In 2024, they doubled revenue to 100 million Singapore dollars, roughly $78 million US dollars. That sounds like a success story, until you read the regulatory filings. Selling expenses more than doubled to 36.7 million Singapore dollars. Administrative costs rose 40%. Net losses quadrupled from 2.2 million to 9 million Singapore dollars. They expanded into Vietnam and the Philippines, adding new subsidiaries and heavier capital deployment. Total investment in subsidiaries jumped from 28 to 45.6 million Singapore dollars. Oatside is running the exact same playbook that destroyed Oatly. Expand aggressively into multiple markets simultaneously, spend heavily on marketing and distribution, and worry about profitability later. Their revenue growth is impressive, but their losses are growing alongside it. And Asia is the same market that punished Oatly, punished Minor Figures, and is now crowded with dozens of local competitors who can produce oat milk at a fraction of the cost. Oatside's valuation reportedly sits around 700 million US dollars. That's a massive bet on a company that has never turned a profit, is aggressively burning cash, and is operating in the most competitive oat milk market on the planet. So here's what these 5 companies have in common. Every single one of them tells a beautiful story about the future of food. Plant-based is growing, dairy is declining, oat milk is better for the planet, better for your body, better for the animals. All of that might be true, but none of it appears in a financial filing. What appears in a financial filing is revenue, cost of goods sold, operating expenses, net income, and cash flow. And what those filings show across every major oat milk and plant-based company on the market is the same pattern. Rapid expansion funded by investor money, persistent losses that don't shrink as fast as revenue grows, thin margins on a commodity product that should theoretically be cheap to make, and an uncomfortable dependence on hype, cultural trends, and marketing to sustain demand that the underlying economics don't support. The dairy industry spends billions on lobbying and marketing. Oat milk companies have to spend just as much, but they don't have the margins to fund it. That structural disadvantage is visible in every single set of filings I just walked through. The category isn't dead. Oat milk is real. The demand is real. But the business models behind it are still broken, and the filings prove it. So, the next time someone tells you to invest in the future of food, tell them you already did your research. You read the filings. And the filing said, no,